Good morning, everyone, and welcome to the Future of Money, the Genius Act, Stablecoins, and the Global Expansion of Blockchain-Based Finance. My name is Daniela Tisch. I'm the Managing Director of the Richman Center for Business Law and Public Policy at Columbia Business and Law Schools. The Richman Center is a joint initiative of the Law School and the Business School dedicated to bridging scholarship and practice at the intersection of business law and markets. It is in that spirit that we gather here today, and we are fortunate to have such distinguished panelists here. I'm delighted to introduce our moderators who will guide our conversation today. Todd Baker is a senior fellow at the Richman Center, where he also teaches an advanced seminar on fintech. He has previously served as senior fellow at the Harvard Kennedy School and as an adjunct professor at Stanford Law School. Earlier in his career, he was the Chief Corporate Strategy and Development Officer at 3 major domestic and international banks and a corporate and financial services partner at 2 Am 50 law firms. Jeff Gordon is a Richard Paul Richman Professor of Law at Columbia Law School and the co-director of the Richman Center, the Columbia Center for Law and Economic Studies, and the Milstein Center for Global Markets and Corporate Ownership. Professor Gordon is a leading scholar of corporate governance and financial regulation. In addition to his work at Columbia, he serves as a visiting professor at the University of Oxford. Please join me in welcoming Todd and Jeff.
Well, good morning, everyone, and welcome. We're here today to talk about stablecoins, or more accurately, fiat stablecoins. What are they? They're digital tokens on a blockchain representing a claim against the issuer of the token, backed by short-term financial assets like U.S. Treasury T-bills. They're fundamentally a centralized, controlled asset, so they're far away from the decentralization dream of Satoshi Nakamoto. How are they used? Today, mostly as a vehicle for facilitating trading in crypto assets like Bitcoin and Ethereum. Tomorrow, they're likely a big piece of the real-world payment system. And someday, perhaps, a new form of digital money with consequences for the structure of our financial system and domestic and global financial stability. We're focused today on the Genius Act, which has been called the most significant piece of financial legislation in the U.S. since the 2008 financial crisis. It's also part of a larger agenda promoted by the Trump administration and aimed at maintaining U.S. leadership in digital finance by integrating blockchain-based crypto assets into the traditional financial system. Every day brings new developments in the stablecoin space, and keeping up with events is pretty much a full-time job. With that in mind, let's get started. We're kicking off with Josh Boehm, who will give us an overview of the Genius Act. Josh is a partner in the financial services practice at Paul Hastings here in New York. His practice focuses on advising innovative companies on regulatory and commercial matters involving financial technology, with a particular focus on blockchain-based products and services. Josh.
Well, first of all, thank you very much, Todd, Daniela, and Richman Center for putting together this event. It's really a pleasure to be here, an honor to be part of this distinguished group of panelists today. And also a big thank you to the students here today, coming up at the very ambitious hour of 9 a.m. on a Friday morning on a university campus. I think that says something about the importance and profile of the topic that we're discussing today. So before jumping into what the Genius Act is and what its implications are, hopefully take a big step back and discuss how do we get here? How do we end up with this landmark piece of federal legislation that arguably is the most significant since the Dodd-Frank Act? It really is remarkable that we're talking about a type of asset, a fiat-backed stablecoin, that quite literally didn't exist 15 years ago. And today, there are, by varying estimates, $250 to $300 billion of these outstanding. And stablecoin issuers collectively are some of the largest holders of U.S. sovereign debt in the world, on par with countries like France and Brazil. So what really motivated the Genius Act? There are a number of factors, but if you had to boil it down to one, I think it would be they became too big to ignore with those holdings of sovereign debt. And policymakers looked at the landscape and how stablecoins were regulated today. And by and large, the status quo is that they're regulated in the US under a patchwork of state money transmitter regulatory regimes, which are good and tailored for what they're intended for, but they really aren't fit for purpose for large scale money instruments like stablecoins have become. There are varying standards across states, including with respect to the reserve assets. And with the exception of New York, which has had a prudential regulatory regime for stablecoins for some years, you wouldn't really call the existing regimes prudential in the sense of having comprehensive supervision and capital and the sort of bank-like supervisory aspects that there was a broad policy consensus are needed at this time. So the act comes into place and it does a couple of really important things. First of all, it defines what a stablecoin is as a threshold matter. Todd alluded to some of this in his introductory remarks, but there are 4 basic criteria. It needs to be a digital asset. It needs to be designed for payment or settlement. It needs to be redeemable for a fixed amount of monetary value. That's a key bit. That has to be a monetary value, including a national currency. And the issuer has to represent that it will maintain that constant value. This is important because it expressly excludes a whole number of other crypto assets that have been widely described as stablecoins in some form or another, including so-called algorithmic stablecoins that are based on, that purport to maintain a constant value based on a computer program, or others that are based on precious metals. Those are out of scope. They're governed by other laws. What this law focuses on is fiat-backed stablecoins. The law also specifies who can issue stablecoins. In general, in the United States, there are 3 main pathways. There's a pathway for federal issuers, for certain state issuers, and for subsidiaries of insured depository institutions and credit unions. And I'll detail those in a minute. There are also certain pathways for foreign issuers that meet certain criteria for an exemption. In terms of the standards that the Act sets forth, there's a broad list of what I would call a mix of requirements, limitations, and prohibitions. Some of the core requirements, again, track the precedent that the New York Department of Financial Services set in establishing the first prudential regime around this area, around 3 core elements: reserve composition, basically what needs to back a stablecoin, what the issuer needs to commit in terms of redemption, and what are the requirements for attestations. Taking them in order. For reserve composition, the Act requires that stablecoins be backed by high-quality liquid assets. And there's a number of details, but broadly speaking, including demand deposits, short-term treasuries, and other long-term treasuries that are within 3 months of maturity, and repos, reverse repos, money market funds, broadly based on the same. For redemption timing, the Act is a little bit more principles-based. It says that the issuer has to have clear and conspicuous policies for redemption. And importantly, the issuer can't have a discretionary right to refuse redemptions unless that's authorized by the prudential regulator. That differs from the status quo in a few ways. The New York has a standard of 2 business days. It remains to be seen whether that's clarified in the Genius rules. And there are some issuers that maintain discretionary ability to throttle or stop redemptions in some cases. Genius eliminates that. Another big pillar is attestations and audits. There's become something of a market standard and expectation among leading stablecoins that this is done, and New York expressly requires it, that there is a monthly audit of the claims the stablecoin issuer makes that their stablecoin is fully backed by permitted reserve assets. These are made public and they are attested to by an independent third party. And that's become a clear part of giving the public comfort that the assets are really there. And that was enshrined in the Genius Act. Other key components in the substantive standards include capitalization requirements, which I'll detail in a minute, anti-money laundering and sanctions requirements, a critical part in negotiating the bill. By and large, and the key takeaway is that stablecoin issuers are financial institutions under the Bank Secrecy Act and have to comply with bank-type standards for their AML program, including having a customer identification program. This is a notable difference from the status quo Many stablecoin issuers today are money services businesses that have different rules under the Bank Secrecy Act, including not a requirement to have a CIP. So it's bringing that up a level. Other requirements include marketing requirements. You can't brand or attach your stablecoin in a misleading way. In particular, you can't imply it's backed by the US government or it's fiat currency or it's legal tender in any way. You can't tie your stablecoin to the provision of other services. You have to hold the reserve assets in a certain sort of permitted set of custodians, broadly limited to US financial institutions. And there's a set of prohibitions around the types of other business activities that the issuer and its affiliates can undertake. The key sets of limitations are as follows. First, the issuer really needs to limit itself to issuance and related activities. Issuance, redemption, purchase and sale activities, custody activities, unless given special permission to do additional digital asset service right activities by its regulator. The idea here is to keep the stablecoin issuer somewhat of a monoline business to help lessen the likelihood there could be other creditors of the issuer that could make claims against the reserves. There's corresponding bankruptcy protections, which we'll also detail in a minute, that help reinforce that policy objective. Another significant set of business activity limitations are around certain types of non-financial companies. Genius also prohibits certain of those companies presumptively from being stablecoin issuers unless they can persuade a committee consisting of the Treasury Secretary and some other regulatory heads that having that non-financial company issue stablecoins doesn't threaten financial stability of the U.S. and that they'll have appropriate protections around data privacy. This is informed by the experience that Congress had with Meta's attempt to issue a stablecoin 5 or 6 years ago, which engendered a significant amount of political opposition before Meta ultimately abandoned the project. So there's a pathway for a big tech company or someone similar to do it. You just have to overcome certain presumptions. Last but not least, there's limitations on the ability of the issuer to pay yield or rewards on the stablecoin. This is a very hot topic, probably one of the most hotly debated topics in Genius and its rules, which we'll talk about in more detail on our panels as well. As I mentioned, a number of the details in the Genius Act are left open to rulemaking, and there's a number of issues to sort out. The Treasury Department just issued an advance notice of proposed rulemaking last week, and so that process is already underway. They are supposed to get these rules done within a year, and the act is supposed to take effect by no later than January 2027. So it's a fast timeline, and Treasury is really moving forward on that. Some of the key issues that we're seeing in our practice are the ones listed here. Again, beginning with stablecoin yield and rewards programs. The law on its face prohibits issuers from paying yield or interest that is solely in connection with holding use or retention of that stablecoin. And for the lawyers in the room, language is very important here. The prohibition applies to issuers, not on its face to affiliates or other partners. And there's a solely qualifier to the in connection with. So on its face, there are textual arguments that if the issuer bases the payment of rewards on something in addition to the holding use rewards, it could be permitted. In seeing this issue, banks have come out and urged Congress to revise this provision and or an alternative to have agencies narrow it in rulemaking on a concern that programs could be structured in a way where they could function in a manner effectively equivalent to deposits. And that could lead to, in their view, a flight of deposits from the banking system, which could increase the cost of credit. And so we'll discuss that more later in the panels. I just wanted to preview the issue and provide the statutory context for why it is an issue. Another consideration is insolvency protections. As I mentioned earlier, one of the big goals of Genius, this was an important goal, was to provide clarity around treatment of stablecoin reserves and stablecoin holders in an issuer's bankruptcy. But arguably, Genius went a little too far. It was arguably a bit too protective because it provided stablecoins a super priority over all claims and somewhat intentional with that, excluded the reserves from the property of the estate. This creates a couple potential issues. One would be with that super priority with respect to reserves, depending on the composition of that issuer's assets, if it entered insolvency, there may not be incentive for lawyers and others who typically have administrative claims that are at the top of the heap to work on those cases, which could impede the effective administration of these cases unless there are pro bono corporate bankruptcy lawyers willing to take these cases on. Another issue is around the exclusion of reserves from the estate. Could raise an issue in, for example, a Chapter 11 proceeding with the trustee or debtor in possession acting in that capacity. Would it have the duties and obligations with respect to those reserves if they're excluded from the estate? Typically, the trustee is only responsible for the estate and the property of the estate. So those details need to be worked out. Capital requirements. This has historically been a very significant issue for banks in particular, considering getting into the stablecoin issuance space. Banks are subject to a number of capital ratios. One of them is a so-called leverage ratio, a very simple measure that, in essence, to be well capitalized, you need to have a 5% equity cushion in comparison to your assets. If you look at how stablecoin businesses are structured, let's say you have on 10 billion of assets and liabilities, and those assets are not very high yielding. You can't issue mortgages with them. You can't make car loans with them. And if you have to pay distributors a certain part of that yield to get the stablecoin out into the market, the return on those assets can be very limited. It may not be a sufficient return on equity to justify the business. So Genius recognizes this and calls for bespoke capital requirements for stablecoin issuers. It remains to be seen whether they'll be structured in a way that balances the need for appropriate buffer with the corresponding need to have them being set in a way that allows the businesses to be commercially viable. There's requirements around anti-money laundering requirements. Many of the details there are left open. One of the, I think, very notable parts of this bill are going well beyond stablecoins. The bill invites broad input on how blockchain, AI, distributed identity can be used to improve anti-money laundering techniques, and even beyond the stablecoin space. And so that's part of a separate rulemaking that Treasury commenced last month, and it will be very interesting to see where that lands. One remaining key issue to watch would be the standards for certifying state regimes as substantially similar to the federal regime. This is a requirement for states to be able to issue stablecoins. That same committee I mentioned earlier will be tasked with reviewing state regimes from states that want to be in the game of stablecoin issuance to certify whether they are substantially similar, allowing the issuer to issue under that state regime until they hit a level of 10 billion in outstanding stablecoins, at which they would need to transition to a federal framework or get a waiver from that requirement from the applicable federal regulator. There's similar exemptions that need to be defined for foreign issuers. There's even the lower bar there, the foreign regimes be comparable to the federal regime. And that also needs to be built out and defined in rulemaking. The bottom line there is that the definitions and the fitness of those standards are going to play a significant role in determining how effective is this federal floor that Congress tried to create with the Genius Act. If the standards are loose, they're not tightly enforced, there could be an incentive for issuers to go to less rigorous regimes and launch stablecoins in competition with those who are buying with more onerous regimes. I have a few minutes left, so we'll go more quickly through these remaining slides. Broadly speaking, three main paths to being a domestic issuer. As I mentioned earlier, there's a set of federal issuers, which will be regulated by the OCC, the National Bank Regulator. There's those entities can operate presumptively nationwide without having to get other state licenses, and they're not subject to a cap on issuance. State qualified issuers, as I mentioned earlier, they need to be launched in a regime that has been certified as substantially similar by that stablecoin certification committee. The law is not 100% clear on this, but the best reading is that most state issuers would still be subject to applicable licensing requirements in other jurisdictions. There are some exceptions and some potential pathways state issuers could use to get exempt from state licensing requirements, which need to be built out in rulemaking. Third main pathway is for subsidiaries of IDIs, insured depository institutions, and credit unions, which would be able to operate nationwide in the same sort of way as federal issuers. The general paths for foreign issuers. They can domesticate their issuance, and that could include a federal branch of a foreign bank operating in the United States. A foreign issuer could seek an exemption or reciprocity under pathways that are set forth in Genius. Broadly speaking, the exemption again requires that foreign regime be comparable to the U.S. regime. The issuer must hold reserves in the United States sufficient to satisfy liquidity needs in the U.S., and they need to register with the OCC. A third path is not to sell directly in the U.S., but to distribute through a digital asset service provider in the U.S. There are some conditions for that. The DASP, which is basically an exchange, would need to register with the OCC, and it would not allow the issuer again to sell directly into the U.S. To wrap up, a few key things that the Genius Act doesn't do. As I mentioned earlier, it doesn't regulate what you would call non-payment stablecoins, the algorithmic stablecoins, the stablecoins that derive their so-called fixed or stable value from some other reference asset other than a fiat currency, not regulated by Genius, subject to other laws, whether they be securities laws, commodity laws, or otherwise. The Genius Act also doesn't generally regulate crypto asset activities involving native crypto assets such as Bitcoin and Ethereum also continue to be regulated under other laws unless and until a federal market structure bill passes, which is still in the works. Several other notable issues Genius doesn't impact include tax. It doesn't touch on it at all, but tax is a really important issue for stablecoins. And Treasury recognized this in the advance notice of proposed rulemaking and said, Genius doesn't talk about tax, but we're going to ask about tax because we oversee that issue, and we need to clarify what would the treatment of these stablecoins be. The treatment is a debt instrument that could have a lot of complicating effects on the ability for them to be really used as a means of payment in commerce. So that's another issue that Treasury has asked for a specific comment on. Genius also doesn't get into detail around information security, cybersecurity, vendor management standards, presumptively on the assumption those should be left to prudential regulators, but they are, in my experience, critical issues for stablecoin issuers. New York, for example, has a comprehensive regime under its Part 500 rules for cybersecurity that applies to issuers. Last but not least, the Genius Act does not change the eligibility requirements for obtaining a Federal Reserve master account. This was a debated issue about whether it should or shouldn't. The law actually addresses it, just says it doesn't expand or can contract the eligibility standards. And so what that will likely mean in practice is some issuers will be statutorily eligible. They'll be depository institutions. Others won't. And it remains to be seen whether when such issuers that are legally eligible submit those applications to their applicable reserve bank for access, what the review and approval process will look like, because it would be a novel step to have a stablecoin issuer approved by a reserve bank to hold reserves at a master account. I'll stop there if there's time for any questions, or otherwise we can move on to the panel. Thanks.
Thanks, Todd. We're going to hold questions until we get to the panel. But I want to say that one of the things that I take away from what Josh just said is there's a lot that isn't clear that's going to be hopefully cleared up in a regulatory process over the next year and a half. Although I would challenge everyone to realize that regulatory processes, particularly anything that varies at all from the words of the statute, are significantly open to question under recent Supreme Court precedents. So the Treasury is fairly limited in what it can do moving away from the wording of the statute. So it'll be an interesting test case for our new judge-focused regulatory interpretation structure. So next up is Ben Isaacson, who's going to talk to us about how stablecoins fit into the domestic and global payment system today. Ben is the Senior Vice President of Strategy at the Clearinghouse. He leads innovation as well as TCH's connected banking initiatives. He's also the co-chair of the board of the Financial Data Exchange, or FDX, a consortium working on a common standard for the secure access of permission consumer and business financial data, and one switching topics slightly that is entirely critical to the whole question of consumer access to financial data, which is a big separate issue and relates to a separate rulemaking around what's known as Section 1033 of the Dodd-Frank Act. So Ben, tell us what's happening today.
Great. Thank you, Todd, and thank you everyone for having me today. I think we're all here because there's a lot of hype around stablecoin, and people are interested. Every day there's new market activity, M&A activity, IPOs, lawsuits. You know, you name it. Every day there's a new surprise. So what I'm going to do over the next 20 minutes is talk a little bit about, you know, kind of the excitement around stablecoin, right? Is it better, faster, cheaper than fiat currency? And we think the best way to do that is to kind of compare the two. So we'll talk a little bit about some key dimensions around that comparison: speed, cost, value-added services, safety, and soundness. And comparing a little bit, you know, the fiat world, the US dollar, the payments we all make today, to and the banking services that are provided, to the stablecoin world that is rapidly evolving. There will not be a lot of definitive answers today because the market is moving so quickly, but hopefully this will be a good, you know, kind of a good baseline for where we sit today. So just to jump in before we start with the comparison, it probably makes sense to start with a description of what fiat currency is and kind of how it works today. So US dollars are made for payments and banking. They've evolved over hundreds of years, and that's important because a lot of the regulatory requirements, a lot of the way payment systems work have been evolved through hundreds of years of trial and error. When things go right, they expand. When things go wrong, they get fixed, and new laws are brought in to address that. Fiat in the US, it works, you know, domestically. There are lots of different payment systems. There's RTP, which you know, the clearinghouse runs. It's a real-time payment system. There's ACH, which is a batch system, which normally does things like bill pay and payroll. And of course, with consumers buying things at stores, there's credit cards and debit cards. And those all have very specific rules that have been built by their networks. And by and large, I think domestically people would think, you know, payments work today. That to a consumer, so they don't necessarily, the payments don't necessarily all clear and settle real time, but to a consumer, the perception is by and large, these are real time payments. If you go to a store, you make a payment, you walk out with your good. And that's really important because that really sets the bar for what, if stablecoin is better, faster, cheaper, what it has to be better than. So, you know, so we have those domestic services. And then when you look cross-border, things get a little bit different. So first of all, the main payment system to affect a cross-border transaction is a wire transfer. And typically the way that works today is through this notion of a correspondent banking system. And a correspondent banking system is really a series of agreements between banks all around the world to affect payments in each of the markets that customers need to send money to. So I'll just make up numbers for a second. If I'm a large money center bank and I have a deep correspondent banking relationship business, I will have direct relationships with, again, making up numbers, about 30 countries, right? These are, call it the G30. They're the markets where I have enough volume going back and forth with those markets to justify having a direct relationship with the bank there. But then I have indirect relationships with another 70 markets. And these are markets where the banks I have direct relationships with have direct relationships with another market. And that's just how cross-border payments work. And it's the mechanism that's evolved over many years to send money all over the world. And it works, but it gets very complicated, especially with indirect markets. And I want to talk about this because when you compare stablecoin to fiat, it seems to be this challenge of how do you send money all around the world to indirect markets. It seems to be a big gap. So if I'm sending money to direct markets, let's say example US to UK, payments work pretty well. There's banks on both sides that have direct relationships. The money moves quickly with certainty and with transparency. If I'm sending money from the US to Peru, I might not have a direct relationship. So first I have to send the money to a bank in Mexico, which might service all of Latin America. And that bank in Mexico gets the money, has to do all the regulatory compliance requirements as required by Mexican law. And then they send that money off to Peru. And that multi-step process can result in gaps. It can result in slower payments. It can result in gaps in information. And so that's kind of the global environment of payments in the US. So that's kind of the description of fiat, kind of key there. I think the one other thing I'll mention around fiat is the just massive amounts of regulation around banking and payments. So over 200 years of banking and payments in this country, there's a whole laundry list of regulations that anyone in that business has to adhere to. Everything from some of the BSA, AML activities that are covered under Genius Act to all the safety and soundness requirements that banks are required under their prudential regulators, to all the fraud requirements under like Reg E and Uniform Commercial Code, and again, just a laundry list of activities. So when you think about both the regulatory requirements, but also almost a guideline to what a payment system at scale needs to look like to operate in a safe and sound manner, the current system has a lot. Now, people can argue it has too much. People can argue it can be streamlined. But all those mechanisms were implemented for a reason at the time. And many of those reasons are because something terrible happened. So that's the current market. Now let's go to stablecoin for a second. So I think Todd and Josh did a great job describing what stablecoins are. So we don't need to spend too much time on that. But what I do want to spend a minute on is kind of talking about the chain part or the coin part of stablecoin. So because stablecoin is a digital asset on a blockchain, it has certain characteristics that are important in that comparison between the two. So one, it's atomic settlement. So in theory, the settlement happens real time between the sender and the buyer. It is a credit push payment, so it's being sent by the sender to the receiver, which is different than how bill pay and many other kind of systems work in the US. And it's programmable, so there is the ability to build certain actions inherently into the coin itself, which allow for certain kind of multi-step processes to happen. So think about them as like process automation or kind of if-then statements if you're more kind of computer science minded, that are attached to the payment that allow for certain actions to happen around the payment itself. So that's stablecoin, and those are the descriptions. So what I want to do now is stop for a second and go into main comparisons that we talked about. So first we'll talk about speed, which is faster and in what circumstances. So if we talk about in the current fiat payment system, when you think about it domestically, again, there's mechanisms that are real-time, like real-time payments and FedNow. And if you bank at one of the 1,000 banks that offers real-time payments, you can send and receive money in real time, 24/7, 365. So, but those are domestic transactions. And again, there's other payment systems like credit card, debit card, and ACH, which don't settle in real time, but give the perception to the at least the sender that it's a real-time payment. And we've seen that a lot as you adopt new payment rails. If there's a perception of real time, it makes it really hard to move the needle from kind of an old payment system to a new payment system. Because even though theoretically there's an improvement, in the customer's mind, there's not. So that's kind of the domestic side of the payment. When you start to look at cross-border, it's governed by the wire system, which is not 24/7, it's 22/5 today, because those are the Fed operating windows. So where that starts to break down is in two places. So one is if you want to send money on the weekends, you can't do it. And two is, the 22 part, that 2-hour window doesn't seem like a lot, but if you look in global time zones, it starts to matter. So you can send money at 12 o'clock noon in the US, but that's midnight in Asia, right? So you and you can have a gap that hey, the payment system is off at 12 o'clock midnight, which is noon in Asia. So you start to there is some pain due to that breakdown. And then the other part about speed, and we talked about this, is that the gaps in the correspondent banking system. So in those indirect relationships, let's call them multi-hop markets, that's where speed can start to take days. So I've seen, plenty, and I'm sure you've all seen plenty of analyses on this on, LinkedIn or blogs or what have you, that talk about, the wire system can take 2+ days to set. And theoretically, that's true, but that really only happens in these indirect relationships. And for, the one stat I can kind of share about that is, in terms of size of that, if you look at the WTO, what they'll tell you is 86% of global trade happens between G30 markets. So when you start to look at where these kind of big delays happen, it's usually on the edges. So that's kind of the cross-border piece of it for fiat. So now let's talk about speed for stablecoin. So we talked about the fact stablecoin is atomic settlement. So it should settle real time, 24/7, 365. Couple of caveats around that as well. So one is that's based on network capacity. So how fast can the chain send transactions? And most of the chains, especially the big ones that were developed early, weren't really designed for payments at scale, right? Payments at scale, you're talking about moving millions of transactions a second. Many of the networks don't do that today. They're trying to, they're making advances in the network to get there, but they're not necessarily there today, which means that network capacity can be a problem. So it can't move atomically if you're waiting in line to set. So then there's the next piece of it, which is, depending on who you talk to, you can call it a congestion fee, an expediting fee, but basically there's a fee that you can add, which will accelerate your payment by paying the network or the nodes of the network to validate the transaction faster. So in Ethereum, it's called a gas fee, and that can go up depending on how congested the network is and how fast you want the payment to move. So again, theoretically, real time, practically, you can either get a real time or not, depending on the congestion, or you can get a real time, but you'll pay a lot more for it. So that's kind of the speed comparison. The other piece that's probably worth noting with stablecoin is that if the receiver wants stablecoin, then discussion closed. We've talked about that. But if they actually want the local currency, So I get sent money and I want, I want a local currency, then you have to go through the FX currency conversion. And that lives in the real world, right? That lives, and then you're kind of beholden to FX market opening hours, bank opening hours, and all the stuff that, so you can get your stable coin on a Saturday, you probably can't convert it to that currency till Monday. So that's kind of the other important aspect around speed. So to recap, in terms of comparison for speed, in the fiat world, domestic works really quickly, especially the perception of the payment. Cross-border in kind of the more developed markets with lots of volume and direct corresponding banking relationships, it can settle within hours. And in kind of the indirect relationship markets, that's where you could get 1, 2, 3+ days. And with stablecoin, it can be real time, but that's going to depend on congestion, and that's going to depend on how much you're willing to pay to get it real time. So that's speed. So now let's talk about cost for a second. And again, I want to use the same breakdown for fiat of domestic versus cross-border. Domestically, payments are quite inexpensive. If you're talking about consumers, they're largely free. In fact, if you use a card, you get paid to make payments. So that's kind of the domestic payments part of it. Cross-border, wire transfer, can be a little bit more expensive. I think one of the key things to point out, though, is in consumer cross-border, banks have largely exited that business. There are, you can probably still do a wire if you want to from your bank, and it's expensive and it's a cumbersome process. But what we're seeing is more and more volumes going to either like the fintechs like Wise or the traditional money transmitters like Western Union, MoneyGram, et cetera. And those folks have much more competitive pricing, and that's largely because they built almost the equivalent of their own correspondent banking network. So that's kind of the consumer cross-border, and then in terms of the wholesale cross-border is much cheaper. Businesses are not spending $25 a wire. The cheapest I've seen is about $1. That's for the largest, but it goes up a little bit from there. But no business is spending $25 for a wire. What is important on the send side is it's actually a fixed fee. It's not variable based on percentage of payment. And for wholesale, that's really important because people can be sending multi-million-dollar payments. So even a very small percentage on that payment adds up very quickly. And so that's the send side. On the receive side, for cross-border is again where the cost starts to go up, and depending on the nature of kind of whether the bank has a direct or indirect correspondent banking relationship. So what typically happens, especially in indirect correspondent banking relationships, is every bank in the chain takes a little bit of money. So in my example before, if I'm sending money to Peru, that Mexican bank in the middle will take a fee. It'll call a lifting fee or a beneficiary deduct fee. Well, there's lots of names for it, but they'll take a fee in the middle, and then the receiving bank at the end will take a fee. So if you're the receiver, you're paying multiple fees to multiple banks to receive that money, and that's where it starts to get expensive. So the more banks involved in that chain, the higher the cost is to receive that money. So that's kind of the cost for wholesale. Now let's talk about the cost. I'm going to start with the cost for fiat. Now let's talk about the cost for stablecoin. So stablecoin, there's two key components. So first, there's typically a small transaction fee, and then there's that expediting fee that we talked about. Call it, in Ethereum, it's gas. These fees, and then depending on the coin, the wallet, the mechanism in which you're going, some will charge a percent, some will charge a flat fee, some will charge a percentage of the overall payment. And again, the percentage of the overall payment, if you're talking about large value payments, that number gets very high. But the flat fees are typically low, and I'd say lower typically than the fiat world today. But what I will say is it's not quite an apples to apples comparison, because when you look at the cost of cross-border payments today in fiat world, much of the underlying provider's cost is compliance. And it's all the BSA, AML, KYC, sanction screening, OFAC, all the laundry list of regulations that are in place. Some of which is covered in the Genius Act, some of it is not. I would imagine that if stablecoins continues to scale, and the use cases grow, and the volume grows, and the perception is stablecoin is money, that whole laundry list of regulations that we talked about before that the fiat world has to live in will likely be largely applied to stablecoin. And, we saw it a little bit, even yesterday, right, when Circle just announced that they're looking at, can you pull back a stablecoin, right? If there's fraud, if there's a problem. So they're almost assuming that there's going to be a world where fraud is a problem, or you're already seeing a world where stablecoin is a problem. Well, we all know what's going to happen, right? The victims of the fraud are gonna complain, rightly so. There's going to be regulation put in place. So you can already see the beginning of new regulation, and my perspective is that the faster and larger stablecoin grows, the more susceptible it is to increased regulation, which means increased cost, and more friction in the system. So that's kind of the cost side. To recap, stablecoin domestically is consumer, the perception is it's free in fiat. Cross-border, it's probably cheaper, but over time, I would imagine the stablecoin cost will increase because the underlying cost to operate will increase. So next dimension, let's talk about safety. So safety, current market, well-established regulatory, 200 years of safety. Key point is it's also permissioned. So banks are the only parties allowing direct access to the payment systems. Everyone else can get access through that bank, but the bank is ultimately responsible for the behavior of their customers. Stablecoins, some folks are talking about also being a permission system, but blockchain in general is public and permissionless, which means that once a coin is issued, even if they're all compliant with Genius Act, that coin can be sent to another party, right? It can be sent to a party outside of the US, which is no longer compliant with the Genius Act, or it can be sent to an unhosted wallet, right? Someone holding stablecoin in their hard drive, right? And so those are inherently less safe and a big issue there. Finally, let's talk about programmability. The process automation and kind of the value add of including process automation inside a payment is interesting. Where we're seeing it today, and we're seeing it in some securities trading and settlement like repos, where they're kind of looking at multi-parties all getting together to automate payments. We look at that and we say that is certainly interesting. In payments today in the fiat world, you don't have the ability to connect a lot of that to your payments directly. So that is a differentiator. When you think of what you can actually do with that process automation, it starts to get more complicated the more complicated you get, right? So if it's one party, you can have a simple process, which is, let's make this payment happen at 5 p.m. That's fine, right? That's pretty simple, you can do that. Then, if you're talking about cross-border trade, you can also make it more complicated and say, I want to pay this payment exactly 10 days after I receive the invoice. because that's when I get my best terms. And that's more complicated because now you have to actually have someone tie the invoice data, which is in a different system, into wherever the payment is getting initiated, right? So that's more complicated, more parties involved, more systems involved. Then you can even make it more complicated, which is, I'm gonna pay it 10 days after the invoice and after you've checked that the goods I received were actually in good working order. Well, then you have to actually have someone in the warehouse doing inventory management, connecting that system. So bottom line is, when you start to get to programmability, the more value you want to get out of it, the more coordination you have. So those are kind of the 4 key dimensions. To wrap it up, I'd say across those dimensions, stablecoin may have some advantages in a few niche areas. But in general, the narrative that stablecoin is better, faster, cheaper will really depend on the use case you're trying to address, the cost of compliance once regulations are actually finalized, and then the abilities of large numbers of trading counterparties to embrace the value of programmability. So I'm probably over, so thank you very much for your time.